If you take the total American debt and divide it by the population, every single citizen owes well over $100,000. It is a staggering amount of money, and right now, that mountain of cash is starting to trigger a catastrophic avalanche. The Federal Reserve acts as the central blood supply for the American capitalist economy. It regulates the flow of money, primarily by raising or lowering short-term interest rates to make borrowing either cheap or expensive. This chart breaks down the true scale of the U.S. debt. Notice that it is divided into three distinct pillars. There is the government spending you always hear about on the news, but there are also the central bank balance sheets and a massive layer of corporate borrowing. Look at what happens when we track those last two pillars over the past decade. The central bank and corporate borrowing portions rapidly expand, completely overtaking the government debt. This creates a hidden web of leverage, tying personal financial health directly to the risks taken by Wall Street. This systemic connection means a failure in the corporate debt market translates into immediate pressure on the public institutions designed to keep the economy afloat. This intense cycle of borrowing kicked into overdrive during the 2008 financial crisis. The global banking system had completely frozen. Banks stopped lending to one another, credit markets seized up, and the broader economy was on the verge of a total shutdown. Federal Reserve Chairman Ben Bernanke needed a massive emergency response. To restart the economic engine, the Fed dropped short-term interest rates all the way down to nearly zero. When 0% interest wasn't enough, they broke the glass on an experimental tool. This flowchart illustrates a mechanism called quantitative easing, or QE. The central bank creates new digital currency and transfers it to private banks in exchange for their toxic mortgage bonds. The hope was that banks would take this newly printed cash and lend it to struggling small businesses. Instead, Wall Street used the liquidity to stabilize its own balance sheets and reinvest in financial markets. The banks recovered, but the broader economy remained sluggish. The disconnect between a stabilized Wall Street and a struggling middle class sparked intense political anger. Groups like the Tea Party organized protests across the country, furious that public institutions were shielding financial elites from the consequences of their own bad bets. Quantitative easing prevented an immediate collapse, but it turned the Federal Reserve into a permanent guarantor of market stability, actively propping up sectors once left to the private market. Over the following decade, political gridlock paralyzed Washington. Congress repeatedly failed to pass significant fiscal policy or jobs bills. This left the Federal Reserve as the primary engine of economic growth, keeping interest rates low to maintain confidence. Then came a massive injection of fiscal stimulus. Under Donald Trump, the government passed historic tax cuts. When combined with the Fed's persistently low interest rates, the corporate sector was suddenly flooded with cheap cash. This bar chart shows exactly what companies did with that historic windfall. They did not borrow this money to build new factories or hire more workers. Instead, they engaged in stock buybacks. Between 2010 and 2019, corporate buybacks skyrocketed, crossing the $6 trillion mark. A stock buyback is simple. A company uses cash to buy its own shares, removing them from the open market.
That system was put to the ultimate test in March 2020. As the pandemic forced a sudden global shutdown, financial markets went into freefall. Credit markets seized up, and investors sold off everything just to hold cash. The response this time was much larger than in 2008. The Federal Reserve, alongside the Biden administration, injected trillions of dollars. They sent stimulus checks directly to households, while the Fed flooded Wall Street by purchasing massive amounts of corporate debt. This rescue operation reinforced the concept of moral hazard. Investors watched the central bank step in to buy even the riskiest junk bonds, signaling that the Fed would intervene to prevent any significant market crash. With money effectively free and little perceived risk of failure, the everything bubble exploded. Billions poured into meme stocks, housing prices soared, and crypto minted overnight billionaires. By acting as the ultimate guarantor against market losses, the Federal Reserve turned the American economy into a no-lose casino. But underneath the record stock prices, they had built a deeply fragile, highly leveraged system. The consequences arrived when all that newly printed money collided with pandemic supply chain disruptions. The result was the highest inflation rate in 40 years. The price of groceries, rent, and gas spiked,
hitting the families who rely on those daily staples the hardest. Initially, the Fed insisted these high prices were just a temporary blip. But at the 2022 Jackson Hole Economic Summit, Federal Reserve Chair Jerome Powell publicly conceded that inflation was not transitory, and it was going to require a forceful response. Look at this graph tracking the federal funds rate. To fight inflation, the Fed brought out the hammer. They hiked interest rates at the fastest pace in decades. The objective was to make borrowing so expensive that demand would fall, businesses would slow hiring, and price increases would cool. But when you aggressively raise rates on a system built on cheap debt, things break. The rapid tightening cracked the largely unregulated shadow banking sector, triggering sudden bank runs and causing the collapse of major institutions like Silicon Valley Bank. The Federal Reserve is now attempting to balance the economy by inducing a controlled slowdown, a process that historically carries the risk of job losses for millions of Americans. The current financial pain is not merely a political issue. It is the result of a hyper-leveraged system finally unwinding after years of unprecedented stimulus. The legendary investor Warren Buffett has a famous saying, "You don't find out who's been swimming naked until the tide goes out." For over a decade, the Federal Reserve kept the financial tide artificially high. Now, that tide is rapidly receding. The era of free money is over. America is entering a period of significant structural adjustment, where the cost of borrowing and the price of debt will define the financial landscape for years to come. Subscribe below to keep tracking how these economic shifts will impact your wallet in the months ahead.